The model portfolios that Intelligent Partnership distributes on behalf of Assetfirst are based around implementing a proven asset allocation using ETFs. So today I wanted to talk a little bit about ETFs and some of the considerations you need to make when you purchase an ETF. And it'll give some idea of the thought process that goes into choosing the ETFs that are used in the model portfolios. At first glance you might think that choosing an ETF is something very simple. Probably you would say you need to look at the cost, what's the total expense ratio, the ongoing cost to the client, and you'd obviously go for the best value or the cheapest. And you might consider performance. How closely does the ETF track its underlying benchmark or its underlying index? Actually, it isn't quite that simple. There are some more considerations, and there are two key topics that it's worth considering in a bit more depth to help understand the process that goes behind selecting an ETF. It's worth understanding more about how ETFs are constructed to replicate the index, and it's worth understanding a little bit more about how we should measure the performance of ETFs. So, how do you replicate the performance of the underlying benchmark? Well, there's three ways really. First is physical replication and full physical replication. So you buy everything that belongs in that index, every stock and share that belongs in that index. Obviously that gives you a very accurate way of tracking the index, but it's also going to be very expensive. A slightly cheaper way would be physical replication, but only on a partial basis. So you could exclude some of the smaller and more illiquid stocks that are in the index you're trying to track. That would reduce your costs, it would make your job a little bit easier, but it also introduces another element where there may be tracking error. The final way of tracking an index is synthetic replication, where you will enter into a swap arrangement with another third party who will pay you a return based on the index. That's the cheapest way of doing it, and it's also the most accurate way of doing it. So you get cheaper and a more accurate ETF. It tracks the underlying much more exactly, but it adds in another element of risk. Because you've got that third party in there, there's an element of counterparty risk, and if they were to go bust or if something bad was to happen to them, then that would have an impact on your ETF. So investors need to ask themselves the question, are they being properly rewarded for taking on that extra risk? And they might be. I mean, a synthetic ETF is a very good investment, or can be a very good investment, but it's important that clients understand that extra element of risk. When it comes to measuring the performance of ETFs, there are two ways of doing it. There's tracking difference and tracking error. Tracking difference is just the difference between the benchmark return and the ETF return over a particular period of time. So it's a very simple concept, but it only gives you a little bit of information. It only tells you about one particular period of time. Tracking error measures the standard deviation of the difference between the ETF returns and the benchmark returns. So it's measuring the volatility of the difference between the ETF returns and the benchmark. So it's just a way of saying how consistently does this ETF track the benchmark. And tracking error is preferred by the financial services community and by the European Security and Markets Association. It's a much more accurate measure. So what sort of things can cause tracking error? Well, obviously a big one is costs. As soon as you add on the costs of running the ETF, that means you're going to underperform the benchmark that you're tracking. Costs can come from the total expense ratio, so the underlying cost to the investor, the ongoing cost. It's actually an interesting aside, but the total expense ratio for most investments, most ETFs, it won't change. So that would appear as tracking difference, but it wouldn't appear as tracking error. Tracking error is measuring the volatility of the differences. If TER stays exactly the same, then there's no volatility, so it wouldn't show up in tracking error. The other source of costs would be transaction costs, things like broker-dealer commissions and stamp duties. Now obviously those transaction costs only impacts physically replicated ETFs. Synthetic replicated ETFs don't have those costs, which is why they're cheaper and why they are more accurate trackers. So physical replicators have these additional costs they have to account for. Other sources of tracking error might be cash drag. If you have to move some of the fund into cash, perhaps to distribute some income or perhaps to rebalance, that obviously can have an impact on performance, because as long as you're in cash, you're not invested in the benchmark you're trying to track. It might have a positive impact on performance. It's not necessarily negative. If you move some of your fund into cash and then the value of the stocks and shares you should be invested in falls, it's going to have a positive impact on your performance. But cash drag is another factor that can lead to tracking error. You might also get a different tax treatment of dividends. So the index that you're trying to track, dividends will be reinvested and there'll be no account of taxation. But of course in the real world, your dividends might be subject to withholding tax or something like that. That would have an impact on your performance and that would lead to tracking error. You might also get operational errors. It's not as easy to run an ETF as a lot of people perceive or think it is at first. And so there is a scope for people to make mistakes. That's going to lead to tracking error. And finally, some indexes are just harder to track than others. So for example, ETFs in emerging markets, they usually have higher tracking errors than ETFs in developed markets. And that's just because some emerging market stocks are more illiquid, they're harder to invest in, there are more restrictions on how you can invest, and of course that just makes it much harder to replicate those benchmarks. What other considerations are there when you invest in ETFs? Well, you have to look quite closely at the costs of buying and selling ETFs. They do have some upfront costs. There's a bid-offer spread. It's interesting to watch that spread actually. If you are investing in an ETF that is traded on an exchange, but the underlying assets are in an exchange that's currently closed, so there's no liquidity behind it, that spread can widen. So it's interesting to watch bid-offer spreads, and you have to look quite carefully and make sure you're not paying too much on the way in. There's also broker-dealer fees and platform fees. They may charge you a commission or perhaps a flat fee for buying an ETF. So you just have to make sure that your upfront costs when you buy one of these things, or your costs at the other end when you sell them, aren't too high as a proportion of your investment. Securities lending is another consideration. We did another video on this that you can find on our website, but in summary, a lot of ETF providers will loan out the securities they have for a fee, and they'll earn some extra revenue. And that extra revenue, it can boost their return or it can lower the costs to investors. But again, it adds in an element of counterparty risk because you're loaning those securities out to a counterparty. So again, the question for investors is, am I being adequately rewarded for taking on that additional risk? Some other considerations. It is actually possible for an ETF to outperform its benchmark, which doesn't sound intuitively sensible, but if they get the additional revenue from securities lending, or perhaps they have a positive cash drag for some reason, they might actually outperform the benchmark. For your traditional buy and hold investor, that sounds like excellent news, of course, but it means that the investment isn't doing quite what it's supposed to do, and it does have issues for people who are shorting the ETF, for example. Finally, there has been another suggestion for how we can measure the cost of ETFs. It came from Morningstar, from some research they did, and they wanted to look at the total holding cost. So they wouldn't look at the upfront costs of buying and selling, but they'd consider all of the different revenues and all of the different costs to the investor. and come up with an estimated total holding cost. And their feeling was that this was a more accurate way of trying to assess the performance of an ETF than just using tracking error. Their thought is you use the total holding cost alongside the tracking error, and that gives you the most accurate picture of how it's going to perform for you. So in conclusion, when it comes to trading ETFs and investing via ETFs, don't just focus on costs and don't just focus on the tracking error. You also have to consider things like counterparty risk, how it's replicating its index, is it doing any securities lending, what are the upfront costs of buying and selling. All these other considerations are crucially important. If you want any more information on these sorts of considerations, you can get in touch with us here at Intelligent Partnership. It's also worth noting the Assetfirst solution, part of that service is Assetfirst are looking at all of these considerations and reviewing the ETF market all of the time to make sure that their recommended ETF meets all these criteria and is the most appropriate instrument for investors who are using that solution.